Ron, let's start with you first. Now, what you're trying to do with Solvesting is to try and get, actually echo what Edwin talked a bit about earlier about emerging markets. So emerging markets is an interesting area, social impact investing. Where do you think that market's going to go over the next few years? Is that a potentially multi-billion-dollar market?
Well, obviously, we definitely think that's where it's going. You see a lot of investment going into developing countries, Africa especially. What we're trying to do is open it up to retail investors, individual investors, which haven't traditionally participated. If you look at growth, Africa is growing both in population and economically, so there's definitely a lot of potential there. And I suppose with the fact that the interest rates are very low in developed countries, there's a lot of money looking for opportunities.
And so talk us through what it is that you're doing. You're working with SMEs, but in the emerging markets.
Right. So we're an early stage startup. Our focus is lending to small businesses in developing countries. The way that we do it is kind of a hybrid model. We don't really do peer-to-peer in the true sense of the word. We basically rely on local lenders to originate and administer the loans, because there's, in developing countries, one of the big issues. First of all, let's talk about the problem. The problem is that there is a huge SME financing gap where demand is much, much higher than what's being provided. The IFC defines it at, I think, at around $850 billion. So there's definitely demand there. But the problem is real. The problem is that there's traditionally been a lack of information. Also the borrower mentality is not the same as in developed countries, so you have to have a more high-touch approach. Hence what we're doing. So Solvesting basically is a platform that lets investors participate in loans to small businesses, and we do it by having loans originated and administered by local financial institutions.
And yield?
We're looking for low double digits.
Low double digits.
Right.
Risk levels?
What?
Risk levels?
Well, hard to say. Hard to say. A bit early to talk about it.
Graham, let's talk a bit about what you're doing. In the UK, we've seen the rise of a platform called Abundance, which is quite a big success. Now, that's got a renewables model, so what Open Energy are doing is not dissimilar model. So can you just talk us through the Open Energy model?
Yeah, of course. So we're a marketplace for renewable energy investments. We have...
US?
Yes, the US. We're based in the US. It is portable, but okay, we're here for now. So we have very high quality loans to US solar infrastructure on our platform. So I think everyone knows what solar is here, clearly. But what does a solar loan look like? If you think of mortgage refi, we provide refi for US solar loans. But unlike, say, refi, where you've got a tenant with a FICO score, you've got Con Ed as your tenant on a 15-year contract to pay at a fixed price. So our central thesis and why we think it's so compelling as a new asset class for marketplace lending is that as a credit investment, it's a proxy for Con Ed.
What's the kind of returns like? Talk us through the ticket prices and that kind of stuff.
So we have a deal that's coming, and the payee, so that if you think of the mortgage refi analogy, the tenant is TVA, which is a AAA rated entity over here. It's a 7-year note, and with a 7-year treasury of 1.9, maybe 2, we're selling it at 7.25. So we're building in, we think, a pretty attractive premium, and we think, well, we know the market's big for this opportunity, so it's commercial scale. So the US solar is residential, commercial, and utility, and we're taking the medium segment, and there's a tremendous opportunity there because there's no natural lender. So the credit dynamics are extremely attractive.
I was going to say, no lender. So do people not lend to that? It sounds like quite a good thing to lend against.
Shh.
Oh.
we want to break the secret, which is there are challenges because if you think in mortgage refi, the contract with the tenant, i.e. Con Ed, those they're called PPAs, power purchase agreements, and they're quite heterogeneous. But we have the skill set and experience to assess that from an underwriting perspective and package it for investors.
So quite blue chip investment proposition, really.
That's exactly it. Yeah, we want to take it. We think it's a very attractive risk-adjusted return.
And again, you're looking at yields of 6, 7, 8%.
That's exactly it. We actually, you could 7 on the money.
Okay, very interesting. David at Bond Street, do you want to talk us through what your particular model is?
Is this one on? Okay. So we are a platform for small business lending. We make $50,000 to $500,000 loans. I think what I kind of want to talk about, which is interesting, is a corollary to Jay's last presentation. I think what he talked about in customer acquisition and marketing and positioning was really interesting. I think reframing that perspective on the relationship that you have with the business is really important.
Yeah.
I think part of my thesis in starting the business was anybody with $1 can buy an ad or send a piece of direct mail. Like, that isn't a proprietary source of customer acquisition. Ultimately, we need to build a brand that people trust, that people want to associate themselves with. And I think one of the most interesting things in starting the business is we've been spending a lot of time talking to small businesses around the country, in New York in particular, and people don't have much loyalty to their banks. And we're seeing businesses that are doing well over $10 million in revenue that are willing to pay a slight premium for a better customer experience. And so I don't think it is just about the price. I think it's reframing that perspective, and it's something we think a lot about.
So how do you provide a different customer experience?
Well, I think ultimately you need to find the customer at the point of intent, right? That's why people pay money, big money on SEM and direct mail, et cetera. There's a few different things that we're doing. I mean, think today, by far the most mainstream way that people still borrow is still going to their banks. So we're currently in integrations with a large regional bank in the Midwest that has $20 billion in assets.
Working with a financial institution.
Yeah, they reject 75% of the people that apply, and so how do you offer a better alternative to those people than higher priced options?
And how do you?
Well, I think by offering them fair prices. I think the market is incredibly inefficient today.
Yeah.
I think people are significantly overpaying relative to the risk of the business. I think the other thing that Jay said, which was particularly interesting, was how do you offer value before the transaction? So we built technology that plugs into QuickBooks, and it plugs into the IRS, and plugs into credit bureaus and banks. How do you widen the top of your funnel by basically saying, hey, come to the site, sync up your accounts, and we'll tell you something interesting about your business? Even very successful businesses. So we, for example, just opened Joe Coffee for the New Yorkers in the room, their 11th location on the Upper West Side. Right? This was a business that had been around for 10 years, well over $10 million in revenue, bankable, had an existing line of credit with Chase, started applying for larger term loans. The process had taken a month and a half. And from data collection to funding, we did it in 4 days.
Wow.
And I think even Jonathan, who owns the business, jokingly said, for 6 years we were running this thing out of a shoebox. We had 6 locations. I think that's true of a lot of small business owners. They're incredibly passionate about what they're doing. They're incredibly passionate about the product, but they're not finance people.
Yeah.
And so how do we, from a technology perspective, that's what I took away from the talk, how do we resurface the data in an interesting way to not only provide better capital, but to help them more strategically think about how to grow their business?
And does that come out in the wash in terms of the product, the way product feels and looks? Or does it come out in the yield structure, or comes out what does it look like?
I think it comes through at every point of customer interaction. I think it's something that we're pretty religious about. And I think it comes from building a beautiful site. It comes from the technology. Anytime somebody picks up the phone and talks to a customer, it comes in the way we decline people. I mean, right now we're seeing referral. We haven't spent really anything in marketing. We're seeing a lot of our volume, most of our volume coming from referrals. Even people we decline are sending us their friends. And I think the way you treat people is really important in this business. Because it is very word of mouth.
And one observation in the UK and in Europe, a very successful small and business lender is Handelsbanken, a big Swedish company, and they're completely emphasized on customer service and completely emphasized on those customer points and touch points. That's their whole proposition. In fact, their rates are a bit crap. but actually what really matters is that whole touch point stuff. So it's something that you think is really important for the industry to get their heads around.
Yeah, absolutely.
David at Yield Crowd. So what's your product set? So talk us through where you think the next new thing is.
Hello. So the majority of so we're a little different. We've actually been doing loans offline for a number of years.
Okay.
And now we're just morphing our offline business online. All of our deals are asset-based loans, the vast majority of which are real estate-based.
Okay, real estate-based.
I think a little differently. I think there's going to be a push at some point in the future, probably not in the next year or two, but probably 2 years and beyond, where a lot of specialty finance, kind of loaning to lenders, could eventually come online and be syndicated out.
So give me an example how that would work.
A tax lien portfolio, someone that's got a pool of merchant cash loans, and he's looking for financing.
Right. An
investment bank, or there's a couple credit facilities now that'll look at a deal like that. We've seen a couple of those deals where, I don't want to say they're mom and pop businesses, they might have a couple $1 million on the street. You can go in there and underwrite their book in some capacity and take a discount, almost like a senior secured, a senior secured position.
And what does that look like in terms of the yield?
In the current market, it's pretty high if it's a smaller guy. It's well north of double digits. So, but if it's a bigger company, obviously they're going to graduate to cheaper capital, and that's going to obviously drive the yield down.
And how much capital do you think can be deployed to this particular marketplace?
I don't know. It's always changing. I mean, on the small balance real estate, which is our core focus, it's a multi-billion-dollar industry. I mean, we're doing $60 million a year online just ourselves, and we're in 2 small geographies.
Which geographies?
We're Eastern Pennsylvania, New Jersey, and South Florida.
Very specific.
Very specific.
And so how big do you think that particular opportunity could be in the end, in the next couple of years? Do you think it could be north of $1 billion?
I think if you add other lending facilities to it, you could probably get to north of $1 billion. That might be very difficult. I mean, there's other players starting to get in the industry now. BlackRock. There's a company called First Key. A couple other players that people here know that are starting to get into the marketplace on the smaller balance stuff, the $1 to $10 million space. Some of these guys, Colony, they're starting to partner with funds. They're lending to resi fix and flip guys, more on the once the project's complete versus the construction financing or the draw schedules. So and they're offering like a 1 to 5 year product. It's like 8.5%. So you're starting to see guys getting in the space, not more for like A grade kind of fix and flip guys, less on the weekend warrior types.
Yeah, absolutely. So it's a particularly good market. David, I want to finish with you. You're, for many years, an ex-investment bank hedge fund, now working a lot, actually still with the hedge fund community in terms of marketing, I suppose. David, you don't have essentially don't have a peer-to-peer platform to potentially tempt everybody here with your attempting to enable people to invest in these platforms. But from your perspective, as being a hedging, if I can use that title, what do you think the big opportunities are?
Well, it's interesting. My company, we do accredited investor certifications, and we built a clearing platform, for those of you who don't know, so that issuers, whether companies or funds or platforms, can tie into a means of getting their investors accredited. And I know how much you guys like that as a part of your overall process, but I think one of the things that we're seeing is that there are 2 elements here driving the market. One is the novelty of the transaction type or style. Much the way buying online or trading securities online 10 or 15 years ago was so new to people, it was almost a bigger deal than the actual asset they were buying. And then, of course, it's the nature of the businesses. These are by and large private companies or hedge funds or startup capital, like the crowdfunding in general. And the early response, or what I'm seeing, particularly on the real estate side, is not surprising. This is an asset class that people can see and touch and get comfortable with, and there's a building there and it has cash flows and tenants and steel and structure. So it's enough to sort of push them past the novelty of the transaction type.
And then they do that, and they do it again, and do it again, and suddenly it's not such a big deal to go on and look at this stuff. So, other than that, from the asset side, there are 600 platforms globally now or something, and there's amazing differentiation in terms of product and service.
And do you think that a lot of the institutional and hedge-orientated money that you talk to on a regular basis is going to be interested in these niche opportunities, or do you think they're going to want, as we talked a bit about earlier, big ticket, lots of liquidity, they want to move 500 million like that? Are they going to be really interested in 1, 2, 3, 5 million pound tickets?
Sure. There's no question. The hedge funds, there's only, there aren't that many relative to the whole universe that are out writing $50, $100 million tickets. Yeah. The vast majority of smaller private equity, hedge, even the institutional investors that will come to this family offices, $1, $2, $5, $10 million transactions are right where they want to be. Money is in most markets free, for lack of a better word. There's almost no risk premium attached to it. So this, if you want to call this an asset class or an asset channel, is of incredible value to institutional investors at the hedge and private equity level, family office.
Well, last question of each one of you. Not necessarily your own businesses. I'm sure they are going to be the next big new thing. But what's the one area that you think is classically underserved, each of you, that actually alternative finance should really get their heads around over the next 2 or 3 years? Not necessarily your business, but something that's really underserved that they really need to think a bit about. Start with you.
Well, obviously I'm going to say small and medium business.
Yeah.
That's the most underserved segment, but it's also the most difficult to lend to. The risks are the highest. And it's growing. Everybody talked about it during the conference, and everybody seems to be targeting that as far as the platform lending because the banks aren't touching it so much. And
so small businesses, I'm guessing you'll probably say the same.
Yeah, we're too focused on the small business segment. I think the area that's particularly interesting to me is one that may already be bankable, or maybe they qualify for an SBA loan, but the process will take them 6 months. I think it's harder to move up market in this space. I think it's much easier to start at a higher position, move down. So I think it would be interesting to see as cheaper forms of capital come into the space, how that affects competing directly with banks.
David?
In terms of sheer volume,
I
would think on the consumer side or the small business side, obviously, is the biggest. I think in terms of risk-reward characteristics, I think specialty finance still holds a lot of weight because there's an underlying asset behind it. And if you're good at underwriting the risk, if you're willing to get a little dirty and buy pools of distressed notes, and I think that's a terribly inefficient marketplace, and there's a reason why hedge funds buy it. But if you're prepared to loan against it, which we're doing currently, and you can see the flow, I think on a risk-reward profile in terms of the yields versus the risk, to me personally, with my own capital, I'd be more interested in that.
Graham?
I think there's a lot of technology development in terms of, if I had another dollar to invest in beyond open energy, if someone could make an alternative to bank box, that would be really useful. So they facilitate, for those who don't know, the payments and they could do with a rival.
That's some ideas for you there, David.
Jetpacks. We need jetpacks. They got phones that do all this stuff, but no jetpack? Elon Musk, come on. No, I think anything specialty, right? Prime finance, you're always going to end up competing purely with piles of bank capital, and banks can get money from the government for free, so forget them. But whether it is dealing with an individual lender who may have a blemish on their credit report, but for whatever reason are financially sound, small startup companies, lack of a track record, all the things that made it hard for hedge funds to raise capital over the years, smart, talented, great idea, no track record. They're all going to become the ones that are pitching you and using these platforms to reach capital. the phenomena that there's a billion people under the buttonwood tree now, as opposed to a couple of hundred guys that are controlling that process, is going to change the landscape of finance over the next decade.
Thank you very much. Thank you very much, gentlemen. We're going to call it a day there.